Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Allie Canal. Let's get to the 3 things you need to know today. First up, Google avoids having to break up the company. A judge ruling the search giant wouldn't have to sell Chrome as part of the penalties in its antitrust case. The ruling did say that Google can't pay to be the exclusive search engine on devices and browsers, but it can continue to make payments for distribution of its products. The stock is popping on the news and helping boost the broader market. U.S. stock futures pointing to modest gains at the open. The tech-heavy NASDAQ is leading the way higher. But the focus for investors today is the bond market. The sell-off is heading into a second day, with the yields on the 30-year brushing up against 5%. There are a few factors hanging over the bond market, including uncertainty over trade policy and the future of the Federal Reserve's independence. Plus, retail earnings offering a mixed picture on the health of the consumer and the economy. Both Macy's and Dollar Tree posting better than expected results, but they also raised concerns about the risk of tariffs in the second half of the year, including the all-important holiday shopping season. Let's get a check on stock futures. You are seeing a mixed picture here shortly before the opening bell. We have the Dow off around 100 basis points. You have modest gains in the S&P 500 up roughly 0.3%, but it's the NASDAQ that's leading the way higher here, up roughly 0.6%. Of course, what's helping us is the tech sector, and particularly Alphabet, after Google won that antitrust case. That's really boosting the broader markets here. You're seeing Alphabet shares up a whopping 7% before the opening bell, extending those gains here. And let's continue to talk about Alphabet, because Google is scoring that major win. A federal district judge ruling that the tech giant will not have to divest its Chrome browser as part of the DOJ's antitrust case against the company. Joining me now is Luria, DA Davidson, head of technology research. Gil, thanks for being here. Let's start broad picture. How significant is this win for Google? I mean, clearly investors are liking this.
It's a significant relief in that the potential for having to spin off Chrome or Android would have been very disruptive to the business. Google has a very well integrated business around those products, and it would have been very disruptive to spin it off. So that's the good news. It's the good news for them. They can continue the arrangement with Apple where they pay them for access to Safari searches. That can continue. So that's the good news. It's probably better news for Apple, but it is good news for Google. There are remedies in here. And what's important to note is that the reason the judge ruled that Google didn't have to take the more severe measures is that it's their assessment that Google will already be in a more competitive situation in the era of AI. And the focus of the ruling is to make sure of that, as opposed to try to break up its current and previous monopoly.
And to your point about Apple, we're seeing shares up around 4% before the opening bell. Now, you brought up AI, and the judge did cite generative AI as real competition. How much does AI change the search landscape for Google?
Well, as we know, OpenAI is already talking about 700 million weekly active users. That's from 2 years ago. And that number is still growing very fast. We know anecdotally a lot of people are changing how they look for information. And we used to Google things, and now we chat GPT things. That's happening in a very broad way. And one of the things this ruling did do is made Google open up some of its data, its index data, its user data, which will allow some of these chat products, such as Perplexity or ChatGPT or Meta products, to access that index data, maybe offer alternatives on various platforms. The ruling also prohibits Google from demanding exclusivity from its partners, which opens that up as well. So that's where we're headed from here, is that some of these chat products are going to have access to Google data. They will have access to those partners and customers because Google doesn't have exclusivity anymore. And they'll be able to compete even more effectively for our searches and chats.
Right. So does that meaningfully change Google's business? And I guess to your point, how much of an opening is this for some of those AI startups?
It is an opening, and it does change the business. The Apple being able to, on the one hand, have this deal with Google where it gets $20 billion a year at nearly 100% margins, but on the other hand, go out and have that not be exclusive and go to other chats and search products and get them to bid means that Google will now have to compete. Google at some point will have to compete for ads as well. That has not happened yet because ChatGPT doesn't have ads yet. So advertisers can't go to OpenAI for their ad needs in search. They still are going almost exclusively to Google. Once ChatGPT turns on ads, Google will be in competition for digital advertising in search. Again, Meta will integrate deeper into search, which will increase competition between Meta and Google. So that's the whole point of this ruling, is that we're not going to break up Google's search monopoly, because in the future, it will be a more competitive market around AI.
Mm-hmm. Now, Gil, you still have a neutral rating on the stock even after this ruling. What's keeping you on the sidelines?
This is good news, but the flip side of that is we actually think the only way forward for Google is a big banks breakup. So it has such valuable businesses that are getting near zero credit between YouTube and Waymo and cloud and the ability to sell TPUs, which, by the way, we think they're going to start doing. Those are businesses that multi-$100 billion businesses that are getting almost no credit because we're so preoccupied with whether Google can maintain its search monopoly. So the fact that there wasn't a forced breakup by the court today means that Google will stay as one unit, which means it'll get valued based on search, which at best right now is a market multiple. It was even lower, but as of today, maybe it's a market multiple. We don't think they can do a lot better until they do a big breakup.
Mm-hmm. So does this outcome make structural breakups across big tech less likely, maybe less regulatory hurdles ahead, considering the ruling in this case?
Very much so. So Meta is paying attention because there's an attempt to make them break up, spin off Instagram or WhatsApp. This sets that back very much so. And for the rest of big tech, there's a little bit more leeway for anti-competitive behavior than there was before. The real big precedent before was Microsoft, which the government pursued very aggressively for many years, 20, 25 years ago. But now we have a new precedent that says, as long as there's some evolution in competition, we're going to allow big tech to behave aggressively without taking much remedy. So it's good news for all of big tech today that the courts may be setting a precedent for them to continue to be aggressive, even in the markets where they're acting as monopolies.
And we are seeing that reaction within the stock market, with the NASDAQ leading the gains before the open. Gil, Luria, thank you so much. Appreciate it.
Thank you.
Macy's climbing after topping second quarter earnings expectations and raising its full year guidance. Yahoo Finance's Brooke DePalma joins me now. And Brooke, I'm looking at Macy's shares up 15% pre-market. What are the top takeaways from the earnings report?
Certainly, this is a strong report for Macy's heading into that key holiday season. And what we heard from Macy's was that this is the strongest quarter for same-store sales growth than it's seen in the last 12 quarters. And that's what's really driving the momentum on top of a raised outlook and a beat across the board here at Macy's. Diving in to those numbers, we did see a beat on both the top and bottom line. But once again, this was the strongest same-store sales growth in 12 quarters. They saw growth in women's apparels, men's, kids, and home furnishing, really leading the momentum there. They also brought in new partners like Abercrombie Kids and contributed or expanded their distribution of other partners as well. They raised their full year outlook for revenue, adjusted earnings, and also narrowed their same-store sales growth outlook. They said that given the uncertainty, though, regarding the impact of tariffs on demand, they believe it's prudent to continue to incorporate a quote-unquote more choiceful consumer into the guidance for the remainder of the year. And that last takeaway there was a strong performance in a tough operating environment. That's what one CFRA analyst said in a note this morning. Really, this is a company that's had to navigate the impact of tariffs that now is included into their full year outlook. CEO Tony Spring, though, saying on the call this morning that their multi-price, multi-category offerings really did help play into the strong report.
And another retailer that you're watching closely is Dollar Tree. Shares are falling around 8% pre-market. Now, they also boosted full-year forecast, but Wall Street not impressed here. So what's going on?
Yeah, not impressed because of what they said about that Q3 outlook in terms of their profit. They had said that adjusted earnings will come in line with what we saw back in 2024. That would be about $1.12. Wall Street had hoped for that adjusted earnings per share for Q3 to be about 20 cents higher at $1.32. And that's what's really weighing on the stock this morning. But despite that, this company did post strong results. They beat them both the top and bottom line as well. They also posted strong same-store sales growth, up about 6.5% compared to Wall Street's expectations of same-store sales growth of 4.6%. And they also did raise their outlook for the year. And once again, this was a gangbuster quarter for Dollar Tree because of that high-income households and all-income cohorts going to the dollar store to look for cheaper goods in this really uncertain environment. And we saw that play out during their quarterly results as well.
Yes, we've just seen that too with the competitor Dollar General. Thank you, Brooke. Appreciate it. Coming up, we counting down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We're watching Campbell's, Polestar, and Kraft Heinz. First up, Campbell's shares are rising before the market open following the food company's better than feared quarter. The company reporting a beat on earnings for the fourth quarter, while organic net sales saw a 3% decline. Looking ahead, Campbell's earnings outlook for the full year falling short of Wall Street expectations, though the company pointing to accelerating cost-saving initiatives to help mitigate core inflation and tariff headwinds. Next, Polestar. The automaker reporting revenue for the second quarter that topped analyst estimates. Polestar highlighting revenue growth of 56% in the first half of 2025, driven by higher sales volumes. However, the company reporting second quarter net loss of $1.03 billion. That compares to a loss of $268 million in the second quarter of 2024. Polestar also reiterating its target of compound annual retail sales volume growth in 2025 to 2027. Finally, Kraft Heinz getting an upgrade from Morgan Stanley. The firm lifting its rating on the stock from underweight to equal weight. Morgan Stanley noting that the decision of Kraft Heinz to separate into two companies allows the new global taste elevation to reposition as a higher growth business with greater international and food service exposure. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Tuesday's bond market sell-off sent yields spiking with the 30-year moving close to 5%, a level it hasn't reached above since the financial crisis. Longer-dated bonds tend to underperform in September, but is this move just seasonality or potentially a troubling sign? George Borey, Allspring Global Investments Chief Investment Strategist for Fixed Income, joins me now in studio. And George, thanks for being here. We were just talking about how the bond market can be a little bit scary. Yeah. So what do you make of the recent sell-off that we're seeing? Why are we seeing long-term yields rise?
Yeah, so Allie, you think about the long bond as the relief valve for investors. There's a big premium when you lend to someone or an entity for 30 years. There's a lot of unknowns between now and then. We know there's a lot of political change. There's certainly inflationary pressures. We're in the midst of multiple wars around the world. There's massive technological change all happening at the same time. When these factors converge, you want to get a premium as a bond investor to compensate for some of those risks. So we've seen bond yields, they've been moving steadily higher really since COVID and are continuing to move higher. And so 5% is certainly a bit of a psychological barrier, if you will, just because it's a nice round number and markets get fixated on nice round numbers. But we think, Allspring thinks, that bonds are sort of moving up towards what we would consider more fair value. That a 30-year bond in the US yielding, say, between 5 and 5.5% is actually fairly good compensation for that mix of risks I just mentioned. And so the bond market is kind of in this, what we would call a normalization phase. And that happens with economic cycles. The long end tends to go up, the front end actually comes down, and the curve steepens. A steep curve is actually typical during a fairly healthy economic backdrop. And that's kind of where we are today. So we think bond yields clearly are moving higher, particularly at the long end of the curve. We're not too far away from that sort of fair value range. And so we don't view this as some cataclysmic, sort of potential signal, but really just the kind of the normalization process as kind of the bond market revalues for this new world that we're in.
And the risk premium you were referring to, that's sometimes called the term premium, and that is what investors are looking for amid all of these uncertainties, whether we talk about inflation or deficit concerns. You were just sort of laying out the picture that we might be in an environment where the term premium remains elevated over the foreseeable future. So is that essentially what you're saying, that we're going to see that higher term premium play out, at least for the coming, I don't know, do you have a timeline on that?
Yeah, no, we would expect the term premium to both stay elevated and probably move up a bit from here. And what we like to say is a bond is a very, very simple, straightforward investment. The bond market is very complicated. And so trying to determine the factors that are going to drive bond prices over long periods of time is very difficult to do. It's very difficult to do consistently. And so you want to get compensated for that long list of risks I mentioned before. And as the bond premium, whether we look at it strictly speaking in the form of a term premium, or if just simply look at the difference between bond yields at, say, the 2-year point on the curve versus the 10-year, or what we like to look at is the 5-year versus the 30-year, it's sort of an average type of spread differential, yield differential between 30-year debt and 5-year debt can be upwards of 150 basis points or more, which is still higher than where we are today. So it's this sort of normalization process that we're working our way through. That list is pretty long. The biggest factor is just inflation. Inflation is the biggest challenge to any bond investor, since you're getting paid in fixed payments as you move through time, and inflation kind of erodes the value of that. We need to be very, very kind of attuned to those inflationary pressures. And they're higher than they've been.
Right.
They may move up in the next couple of months. The market thinks they will eventually come down. But we're in this kind of tough period where inflation pressures are persistent, and so I want to be compensated for that as a bond investor.
And that's being reflected in those long-term yields, right?
Correct,
so
correct.
We are in a market environment where markets expect the Fed to cut interest rates later this month.
Right.
How do you square that when yields are telling us that we're going to have sustained inflation over the long term, yet the Fed wants to cut, presumably?
Yeah. Well, the Fed has a very difficult mandate. Their job is to sort of protect both the labor market and then sort of keep prices fairly well contained. Their target inflation number is 2%. We're above that, not dramatically, but above that, somewhere between 2.5% and 3% currently. And so the Fed needs to decide which side of their mandate are they going to focus on, inflation or the labor market. And the recent statistics would show that the labor market has been softening over the last 6 or 8 months or so. We'll see what Friday's job payroll report is likely to show, but we expect it to show further deceleration of labor. So the Fed can start to ease rates to try and help promote kind of growth, to help the labor market, and maybe take a more softer approach with inflation. As I mentioned, inflation's above target, but it's not wildly out of the range from the Fed's perspective. The Fed's job is not necessarily to get to 2%, but to have the market believe that they will eventually get to 2%. So their time horizon is not tomorrow, but it is over time. So we think there's room to cut rates. They don't need to cut fast and furious. They can cut a little bit and see how the economy starts to unfold. But there's certainly scope and rationale for the Fed to start easing at a pretty slow and measured pace. And that seems consistent with what the Fed Chairman Powell has said and other Fed governors as well.
So there's a lot to keep track of, and we're going to continue to watch the bond market very closely. Thank you so much. Appreciate your time, George.
Thank you.
Well, coming up on Yahoo Finance, opening bid, our own executive editor, Brian Sozzi, joins us now. So, Brian, what's coming up on the show?
Allie, lots to get to. We're going to dig more into that Google ruling, what it means to Google stock, what it means to Apple stock. Also, talking some old tech We're drilling to eBay in my stock of the day. Excited about that one. eBay's been doing pretty well, Allie.
Yeah, no, I'm excited about it too. We'll be speaking with the eBay CEO later on in the show today. But that does it for Morning Brief. Much more ahead on Yahoo Finance. Stay tuned.